started here. Okay, like I mentioned, this is being recorded, and I always say at the beginning of every one of my webinars is watch this again. Even if it's not specifically this webinar on long call calendars, but maybe even another one. But watch these relatively soon after viewing it the first time. The reason why is because the nuances will sink into your long-term memory. The next time you go to use this or implement this strategy on your portfolio, you are going to already know it. Otherwise, you're going to have to go back, watch the video again, and learn this almost all over again. So please watch it again so that it sticks into your long-term memory. And a lot of these little nuances will come to life so that you'll understand them better, I believe. I think the way that I teach options, I try to make it so that there's like little things that will click in your head to help you remember longer. All right, but let me get a couple things out of the way real quick. My name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Started out trading in college. Then I moved up to Chicago right after graduating and started working on the floor. Never filled out a resume, just jumped on the floor and, got my feet wet. This says basically any opinions, news, research, or analysis or other information contained in this webinar or information provided by Pro Trader Strategies and associated companies or employees is for general commentary, does not constitute investment advice, guys. The reason why we don't give investment advice is because we don't know what your risk parameters are. We don't know what's in your portfolio. So we can't give you investment advice unless we know all of that stuff. And because I don't, it's up to you to take what I teach you in these webinars and in the daily market commentaries and throw it into your portfolio in your own way according to your risk parameters and your directional assumption on whatever it may be. I mean, you may be bullish Tesla. I'm not. So there's where the rub lies and why I wouldn't give you investment advice, right? All right. So past performance of any trading system or methodology is not necessarily indicative of future results. Eric, I have not received the previous recordings. They are available, John. Reach out to us and we'll get that to you right away. So I got this blank page up. The reason why is because usually we have a blank mindset when we're going into trading, right? We come up with an assumption. It could very well be because we saw the, let me pull up this one over here. So let me pull up this. We saw that the market maybe had been in a downtrend. We got all these candles kind of going like this. And then we find a candle that pulls out. However you come up with your bullish assumption, and then all of a sudden it gets confirmed. So this being the low area down here, where we found the low is kind of down in here, right? So that's the market bouncing. And now you decide you come up with a bullish assumption, right? There's all kinds of ways. Maybe it's because your 200-day is kind of trailing like that, and then you also have your 50-day just now starting to cross over, so now you're saying it's bullish. However you come up with a bullish assumption, we saw the market maybe do this and now start to rebound up, and we believe the market's going to go higher. However you come up with a bullish assumption, that's usually what happens when we're going through charts and we're looking at X, Y, Z, whatever it is. And we come up with this bullish assumption. You saw a commercial on something and thought, oh my God, that's going to make their sales go through the roof. I don't know what it is. We all come up with our bullish assumptions somehow and in different ways. So all I want you guys to come away from this is we are looking at X, Y, Z, and we have come up with, for some reason, a bullish assumption, okay? Now we have to go through and figure out what is the right strategy for this bullish assumption. There's all kinds of different strategies. I mean, it could be a long call, right? We could have a long call in there. We could have a short put, we could have, but these two, long call is really low IV. And this short put, we would need really high IV, okay? So these two have bullish assumptions written all over them, long call, short put, call spread, whatever it may be. But now we're looking at, okay, well, XYZ, I am bullish and I'm long-term bullish. So I'm getting rid of these ideas right here. because we're kind of medium volatility or whatever, and I'm longer term bullish. So that starts narrowing us down. If we are starting to look at long-term bullish, then that's where we kind of get this little hint where we're going to be looking at creating the long call calendar, because that is for a longer duration, right? So that being said, I'm going to try and do this webinar without the idea that we are creating a long call calendar. I want to get to the long call calendar, but let's go through the process of just knowing we've got this bullish assumption for the long duration, and we need to come up with a strategy in and around it. All right. But a couple of things real quick, or I forgot to throw out there that you can follow me on Twitter at Wolfman's blog as well. So you can throw that out there too. That's where I throw out my earnings trades and whatever other snark might be out there. And how do we do this? How do we build this long call calendar when we're long-term or long duration bullish? All right. So the call calendar is a horizontal spread. Remember, we've done like diagonal spreads and all of those, but the key here with this is the horizontal. That means horizontal is flat, right? So on some of the other ones, diagonals, where we're using leaps and other things, this one, we are going to be using the same call in the front month expiration with, say, 22 days to expiration. And then we're also, this is the call we're selling, and then we're going to be buying a call way out, probably, 100 and maybe 50 days to expiration is going to be about where we kind of shoot for. All right. That's what those are my targets that we are going to be looking for, is on the short call. 35 days to expiration is really what I want to shoot for. We have 22 right now, but 150-ish days to expiration is good also. So when we're doing this, we are going to be selling the at the money, or the closest to at the money. Sometimes it's going to be just out of the money, which is what I prefer to do, is just slightly out of the money call. In the nearest expiration, that's this one right here. We want to get closest to 35 days to expiration. And then out here, we're going to be buying this out of the money call in the further duration. And that's where I was talking. We're going to kind of be looking at, about 100, somewhere inside of 150 days. I don't usually like to go much further out than that. The other thing is the different strikes. We're using different strikes on the diagonal. I think I mentioned that already. The other thing we're going to be looking at here is this at the money is probably going to be about a 45 delta option. And if we're looking at the out of the money, we're looking at about a 36 delta option. Okay. All right. No questions so far. We pretty good so far. So we're selling an at the money in the nearest expiration, and then we're going to be buying the call in the further expiration. Same strike though. Same strike. All right. My essentials to success. Now remember, there was your secret sauce. That's right. Delta choice is based on anything. So delta choice to me is, and I'll have a couple of examples. If you have like a utility stock or maybe a consumer staple, right? Those have a tendency to kind of trudge like this. And that's really what I like the long call calendar is, because remember, we have that short call and we want this one to be worth $0 at the end of it. Okay. So we don't want something that's kind of going like this and making massive moves up and down, because we're going to see huge swings in our P&L for one. I like to have it just kind of trudge up so this call expires worthless. And, in some regards, this call that we are long way out here on the horizon is going to increase in value, not only due to our directional assumption being right, but implied volatility percent, IV percent going higher. Okay. Because we're just coming out of this earnings and we have low volatility, right? But the one that we're going to be setting up with this calendar, the buy is going to be very close and may even have an earnings in it, which is good because that uncertainty drives volatility for us. So that's what we'll be looking for there. Yes, low beta stocks is another great way, probably a better way to describe it, Banu. That's why we invite you, Banu, is because you come up with some good stuff. I'm just kidding. We invite Banu because we love you. Anyway, so picking the right environment. I've mentioned this. Implied volatility is a major factor when we're determining strategies, right? We have a bullish assumption. We've got that. Now, we are trying to figure out what this environment is. And let's just assume, we're kind of cheating here by telling you this, right? Let's just assume here that when we're looking through this essentials to success, we are just looking at X, Y, Z, and we are bullish. We expect it to go up for the long term. All right, long term. So we expect it to go higher on the long term. So we need to pick the right environment. Because we have different option expiration cycles, we need to be very aware of how the environment is. And when I'm talking about environment, this is usually where I'm talking about implied volatility, all right? Implied vol. And what our volatility needs to be is middle of the road is a good one, but it's middle to low, mid-range to low range in implied volatility. So let's just say the implied volatility percent on this should probably be, let's say less than 50%, okay? But it will work in many different implied volatilities. I like to go a little bit lower and make sure that I get an opportunity where my volatility expands in my long call, right? But implied volatility is different across the spectrum here. So there's several things we're going to have to look at. So let me pull up my platform real quick. And when we're looking at implied volatility, hold on, I got to get rid of this now before I can pull this over. All right, so this is implied volatility down here at the bottom. And, you can see it charts just like a regular chart where it'll have it at its extreme highs and extreme lows. What we see, though, is when we come into these earnings, generally speaking, we'll see this volatility spike into those, all right? Of course, American Express probably not the best example, but we can probably just about pick anything else and see that when volatility comes to its peak, it's usually right around those earnings, okay? And then we start to see the volatility come out. In that, Netflix just had earnings, right? So what do we expect? Volatility, when it has its earnings, which will probably be like right in this little area right here, so that's where we're looking to buy our long call, because if we expect volatility to rise heading into that binary event here, right, then our premiums, even if we are directionally wrong on this long call, it's going to be helping us. This volatility expansion will help. So that's what we're looking for on our long call. And then our short call is going to be like right in here where there's nothing going on. And volatility may expect to continue to kind of trickle back down. But this one, we want this one to be $0 at the end, right? So Netflix is a good example of this, where right now we're kind of looking like we're trending sideways. That would be a good opportunity to see our calls lose value. And then as we come into the earnings, we could see the market, if our long-term directional assumption is right out here, then the volatility expanding coming into our long call and our directional move higher will really do well. I am a student, sir. That's right. That's right, Banu. Kevin, can you hear me now? And did anybody else lose sound? Because it looks like on my screen, it's showing that I'm talking almost very loud. Okay. And for those of you who aren't missing out on the sound right now and do have sound, if that ever happens, it's usually go to webinar, sign out and sign back on, and it usually comes back. All right. Amaro says we got great sound. Not too much sound, but great sound. All right. Try and spice it up a little. All right. So that's picking the right environment. The other thing, and one other thing that goes with picking the right environment with this strategy is because we're dealing with different months out the curve here, right? we have to look at the volatility over here on the side. And when we're looking at it, so this is the one we're probably going to sell because it's closest to expiration. We don't want a big difference between the volatility we're selling and the volatility we're going to be buying, which is out here, okay? You can see that this is about a 5% difference, okay? Now remember, we're selling the call here, so we're selling volatility here, but we're buying vol back here. That means we're paying a lot more premium out here than we're able to sell up here. And that's going to affect our overall profitability, because if volatility continues to go down in this month here, then that's going to hurt us, even if we're directionally right. If that vol goes down, it's going to hurt. And we talked about that in last week's webinar. As the volatility coefficient, let's pull up actually, I got too many. That's what I really wanted to change. But you can see as the volatility changes, it can completely offset the theta decay or our deltas. Even if we're directionally right and it goes up $1, we gain 39 cents here. But let's say implied volatility goes down, then those offset, right? The premiums will offset. If it goes down by 1% and, up by $1, these two, this decreases it by 35 cents. This increases it by 39 cents. All right. So that we have to be aware of. And when we're looking at that, we don't want the big difference between the 2 months. So we want, on this type of strategy for our low volatility, a green light. Like we want green lights on this. We need to have less than a 2% difference. Let me go 2%. Less than a 2% difference for a red light or a green light. Less than like 3 to 4% for a yellow light, or right around, let's just say 3 to 4% for a yellow light. And then anything over greater than 4% is a red light. Just walk away. And for instance, this one to here is basically 5.42, right? % difference. So we want to stay away from that. We wouldn't want to do Netflix for this strategy because we are way outside the range of our green light, yellow light, red light, okay? Less than 2% difference. And that is on an increase. You saw here that we got this from 31 to 36. That's increasing, right? So if it is ever 36 here and 31 here, then that is always, sorry, I should have written that in green, always a green light, okay? Because it's decreased. Remember, now we're selling the high vol and we are buying the low vol. So that's good, all right? It's going to help us become profitable faster, because this, as it decays out, our premiums go, like, literally evaporate, all right? And this one, as we planned it out to increase the IV to have increase during that time, all right? Getting a little crazy with my writing, I guess. So less than 2% increase is the best case scenario. 3 to 4% is a yellow light. As long as everything else is following through with these rules, then, as long as you have a bunch of green lights and maybe one yellow light, then I think you're good. If you start getting a red light, one red light, I would say look for another strategy, okay? So that's how we're going to narrow this down. All right, picking the right underline. This is pretty easy in the fact that we just have to look at the option montage. Again, this whole section is the option montage when I have it closed. Everything on this page is the option montage. And when we're trying to pick the right underline, Netflix, for instance, what we do is in the closest the month with the closest days to expiration, the spot month is what we call it. It's where the most volume and open interest is. What we do on a stock that's over $100 like Netflix, you just move the decimal place 3 ticks to the left, and that's what it is. So 30 let's call it 37 cents rounded up, is how wide our bid to the offer should be in the option montage. No wider than that. And this is during open market operation, right? Only applies during open markets. Right? We're after the close right now, so orders get canceled. All right. But during open markets, we would say it's 37 cents because we just move it 3 ticks to the left on any stock over $100. And then if it's a stock that's under $100, we need to have this option montage be at least inside of 10 cents wide to the bid and offer. All right. So we want to, on a stock under $100. So if it's under 100, we want less than 10 cents wide. Okay. Over $100, move the decimal place 3 ticks to the left. And that's pretty much it for picking the right underlying. It doesn't matter. If the markets are tight, even if nobody's ever heard of the stock, if the option montage is tight, being, a couple pennies wide, then that means there's a lot of participation in there, or a lot of traders watching that market. So know that the tighter the markets are, the better off it is for you, for sure. And especially with this strategy, because the further out in time you go, you're going to see these options get really wide. All right. This one's, 30 some odd cents or more. So, and because we are going to be trading out here, we want to make sure we have tight markets. And if there is a lot of participation up front, those eyeballs will be looking back here for sure. All right. And the reason why we don't want wide bid ask is because if I have to give up 25 cents to get in and 25 cents to get out, to get in and get out just to get filled, I mean, that's 50 cents, you guys. That's a lot of money. Rather than if I only had to give up like a nickel to get in and a nickel to get out from the bid to the offer. It's a major difference. So stay away from those really thin markets. All right. And then picking the right duration. This is key to the success of this strategy because we need that theta component in that short call, right? This is where we're doing our short call. This is where we're doing our long call. All right. So you can see the theta component is very slow out here. Now, in some of the other strategies, we were able to kind of get rid of this theta component. In this one, we're not able to because we're doing the strikes at the same strike, or we're doing the same strike but different durations as well. So that theta component is still going to be a factor. This short call, we're going to try and finance a lot of that, and it's going to decay faster than our long call, and that is good for us. All right. This decays quick, gets us out of this short call. Once this short call decays worthless, we're out of it. Now we would want the market itself, not really theta, but we want the market to kind of make a big turn for us. All right. All right. The 2%, 3 to 4%, and 5% and above are the IV differences for the short and the long option on the option chain. Not sure I read that properly, but or got it clear in my head. But what we were looking at here is the difference between the one we're probably going to be buying right here and the one we're going to be selling here. We don't want a major difference here. And as you can see here, that is about 4% difference. Okay, slightly higher than that. Okay, their options probably come in right in there. Did that answer your question, John? The green light, yellow light, red light. Yes, green light is going to be the, if it is, let me just use the, I don't want that. Let me pull this up again. So the green light one, this is a red light, right? Because that's 4% difference. Let's look at another one, J and J. So we can look out here. Let's just look and make sure they've had their earnings. So volatility's basically come out. They're probably going to have an earnings, somewhere, skip a month and a half, somewhere like in here, my guess. without looking anywhere. So I'm guessing it's out there in the options that we'll be buying. So a green light would be if we are less than 2% difference between the one we're buying and the one we're selling. In this one, you can see this is less than that 2%, right? So this is this one from the one we're buying and the one we are selling, you know, that's 16 to 17 and a half. That's the less than 2%. So far with this one, it would be a green light if we were bullish in Johnson & Johnson. Obviously, we have to move the decimal place 3 ticks to the left. 14 cents is kind of like what we're looking for over here in the option montage. Right now, this isn't 14 cents. But remember, we need to make sure that this is open market conditions, and Johnson & Johnson usually fits that rule. And remember, after the close, everybody canceled their orders so they don't have any risk of forgetting about that. So that's what I was talking about with that one. And then let's move on to the picking the right strikes here. Picking the right strikes is our next one. It's important for the directional assumption, obviously. If you are more bullish in this underlying, then you're probably going to be looking to do, if you are, you know, you think the trajectory is more like that, then I would be looking at more of the 36 delta, all right? But if you think it's going to kind of do that, then I'd be looking more at the 45 delta. So it depends more along the lines of how bullish you are or how worried you are about this kind of trajectory, okay? So picking the right strikes is on that delta assumption. So it doesn't really matter if you're using the 45 days to expiration or if you're using the 30 or 35 delta or if you're using the 45 delta. It has to do with how much upward trajectory you think is going to happen in the next, 35 days, because that's the only one we're really worried about. We're only worried about that 35 days to expiration. Won't IV expand as days to expiration gets closer? Actually, volatility affects further duration options more than it does the nearer term, generally speaking. Now, we did in January see, just recently in January, we saw that the front months got jam-packed full of implied volatility, and volatility was clearly affecting those front months more so than the back months. That's not generally the case. Like if it were to happen, next week we started seeing volatility expand, the market started, correcting, you were going to see the longer duration spike faster or sooner, all right? And the closer you get to expiration, you are going to have to worry about that volatility, but know that longer duration has volatility affect it more. That makes sense? All right. So picking the right strikes, that has to do with, our bullish assumption more so than anything, but we're picking the same ones. All right. Okay, good. All right, good. Thanks. Sorry. Sometimes hard for me to read and think. So know your exit strategy before entering the trade. This is going to be really important because when this position increases, when it increases by 30%, that's where we're looking to cover it. All right. So if we pay $1, where do we get out? I got in at $1. We're getting out at $1.30. So it's an increase of 30%. All right. And if we're directionally wrong, the only time I'm going to look to ride this out is if there's an earnings event. Okay. So, if I'm looking like I'm losing money on this and I'm at a full loser, okay, just write it out. It costs you nothing at that point, all right? Or, even if it's only worth 25 cents, I'm probably going to write it out. I started out at that $1. If I started out at that $1 and now it's worth 25 cents, for that 25 cents, I'm going to ride that long call out into the sunset. All right? On the Poston, 30% on the entire trade. So if I pay $1 for this, then yes, I'm going to be getting out for about a 30% increase. That's usually what I do. I don't want to be in this, to be quite honest, for super long. I do want that long duration in order to allow me to be right, okay? But that's not, I'm not thinking 150 days out, I want to be in this trade still. I want to be out in probably the next month or so. And the other thing is, you know, on that short call, this says that the maximum profit is unlimited, all right? You can see that it says it's unlimited. And you're saying to yourself, well, we got that short call. This is unlimited because the assumption is the short call is worthless, all right? The max profit on this is infinity. I mean, as long as it happens in the next 48 days. Remember, it could expire worthless. But the other thing is, with this short call, you can, if it expires worthless or it's very close to being worthless, roll it out in time for more days to expiration and collect more credit with another short call. What does that do? Well, remember, originally we said we paid, let's just say we paid $1 for that original one, and I roll my days to expiration out again, so I'm getting short another call. Well, I collected, let's say, another 40 cents. Well, now I've only paid 60 cents for the overall strategy, right? So if you can continue to do that, absolutely. And in past years, I've actually, or last year, I think it was, we were doing the long call calendar in the daily market commentaries, and I was able to roll my calls out so many times that I was a negative value. I basically collected a credit for the entire strategy, so I had it on for free. So you can do that too. You can always roll it out in time. You know, if it's looking like it, you know, the market, you thought the market was going to do this and kind of move that way, and my short call is expire worthless, and then I got my long call that gets all this action here. Well, now my short call expired worthless, and we're kind of right there, but now it's still going again. And you're like, all right, well, I'm just going to sell another call against it. All right, you can do that. That works as well. You know, anytime you can collect the credit, that's good. Right? And then our max loss is the premium it paid. Remember, because we got that long call way out there and we paid $1 for it, that's the max loss we can lose. We don't have to worry about it. Some people may be saying, well, you've got a short call in there. All right. You have to worry about that because of assignment risk and everything else. But way out here, remember, I've got that long call. So this long call can be offsetting that short call. We don't have to worry about it. When you roll out, do you look at the delta or the money? I usually look at the delta because that's my probability of my best probabilities, right around that 30, especially if I'm rolling it out. I'm probably rolling it out to about 36 delta. Because at that point, I'm going to be rolling up and out in time, and now I'm going to actually have, you know, a call, say this is the 100 call that we started out with. And now if I rolled it out again, you know, I had this short call here, which was the 100 call. Now I'm rolling it out in time. I could probably go up to the 105 call. And I want to continue to do that if I rolled it out again, I'd go up, hopefully be able to go up to the 110 call. Sometimes I might have to go like this and roll it down to the 100 call again because the market went the other way. That's fine too. Just keep playing it. Try and pay off that debit you paid. If you can get it off for free, then absolutely. And yes, you can use weeklies as long as the, I think I spelled that wrong, but anyway, you can use weeklies as long as it follows through with our rule on the tight bid ask, okay? Make sure those weeklies still have a lot of participation in them because the idea is not giving up all that edge. Right? And then our break even is the long option plus the premium paid. So if we were talking about that 100, we got short the 100 calls here, and way out in time we got long these calls at the 100 calls. Well, my break even, and I paid $1 for it. my break even is 101 when the underlying is trading 101. All right. Anytime you pay that debit, it adds in to your overall break even to the upside. All right. So without further ado, let's get the platform up here. This is usually a part of the webinar where I throw it out to you guys. Give me some option or some underlyings that you like to trade and you feel that, hey, I'm long-term bullish in this because of whatever. You don't even have to give me the reason. That doesn't really mean anything right now. We're just trying to come up with something bullish. All right. Somebody says just go with Disney. We'll check out Disney. Let's check out Disney. Now, the one thing we don't want to have is earnings in the option expiration cycle that we're currently trading. So let me just pull up I'll just do the VIX one, steal the VIX chart here, and go DIS. All right, so Disney has earnings in this right here. So you can see our short call is probably going to feel more implied volatility going up, right? So that short call is going to increase in value, all right? So I would wait until after this date, if I'm long-term bullish, after that happens, maybe even do my earnings trade in between there or whatever. But as soon as that earnings happens, you're going to see the volatility come out of it. This is where I would set it up, okay? Like, that's another thing I mentioned at the beginning. I don't know if you guys remember, but I was like, make sure make sure to know that this is a great strategy for long-term bullishness and right after earnings happens. Like, what happens to us after earnings? For me, anyway, it's like you got to go to the premium selling strategies. Well, this is a great one to set up for a long-term premium buying strategy. All right. All right, somebody else threw out Cisco. I'll just stay on this chart real quick just to see when the earnings are. So they got that earnings in here also, which is going to be one of our problems. So somebody else told me to do Johnson & Johnson, which is what made me think of it. So we've got Johnson & Johnson had the earnings. It's kind of gotten the medium to low volatility, really. And then our next earnings is here. So we actually have 2 months that we could, like we mentioned, sell. We could sell a call here and then roll it out and sell a call here. You know, I mean, if it works out for us, because we're buying a call out here and the volatility is going to increase on this call that we're long. So that's a good scenario for it. So now that's how we came up with our bullish assumption, right? We didn't look at the option montage. Let's just say, you know, I'm looking at Johnson & Johnson and I'm like, all right, well, I'm just looking at this and I go, all right, well, they just had earnings. I'm kind of long-term bullish in this. You can see the chart looks like it wants to rally, right? Looks like, yeah, we bounced around this point of control, which is usually where it settles down, right? So I'm good with that. Settles down, but we are still, one could say, making higher highs, for the long term anyway. So we come up, we think it's going to rally over the long term, kind of like that is the idea. And we got the bonus for the implied volatility kicker for us. All right. Microsoft did just have earnings. I just traded that for earnings. So anyway, we're looking at Disney. We need to come in here and say, all right, do we have the option montage? Move the decimal 3 ticks to the left. So we're looking at 14 cents, right? 14 cents for the bid ask. It's a little wider than that right now, but again, we need to look at open markets. We don't have an open market. So obviously during open markets, Disney usually follows suit with that. So I'm going to say this fits the rule for a good underlying. The environment, now we have to worry about the environment here. We look over here at the implied volatility. We've got 25, and then we go out in time. Of course, it's not going to let me go a little bit shorter on the strikes, so I'll go about 8 strikes on this and go back to my thing. So we've got 25 here, and then we're going to go out about 150 days, and we got 22 there. So this is one of those ones where it's a very rare occasion where vol went down, right? So we got volatility going negative, which means we're selling high vol, and we're buying low vol. Low love, vol. Okay, dyslexia showing up. So that we don't even have to worry about that whole less than 2% difference, right? I've got all kinds of crazy things going on with my marks. I'm getting all happy with it. But anytime you see this where it goes down, we don't have to worry about that. It is less than a 2% increase. It's actually a negative 4% increase, right? If you want to do lawyer talk, yes, it's double negative, a negative 4% decrease. All right, so let's check out Microsoft. Microsoft, I'm long-term bullish. You watch the daily market commentaries, you know exactly why. So let's take a look at it. Because I think that they came out with pretty good, they got this big spike in it. I do believe they're going to continue higher, but this could be a scenario where we see the market do a little bit of a rollover first. I mean, these people have got to be dying to cover, right? So I think that market might roll over a little bit here. So I'm good with getting a little bit more aggressive. So you are not saying that Disney is, I'm saying Disney is awesome because Disney was awesome. Wait, Disney, are you talking about Disney or Disney didn't have a negative? I think, yes, Disney did have the negative. Sorry, Disney is great because it has that negative volatility, right? The thing that doesn't make Disney great is the fact that Disney has the earnings in the month that I want to sell, right? There's better strategies than the long call calendar for an earnings trade, especially this close to an earnings, all right? I would wait till after the earnings to put this on if you're long-term bullish, get that, binary event out of the way, because we're selling this call before the event. We would expect volatility to continue to increase, all right? So you're taking some risk into that earnings event as far as I'm concerned. I think there's better strategies for it. But because it has that earnings event is why I discounted it. Because it has that decrease, that's a good thing. I mean, it fits everything else. The red light is that there's an earnings right here, and I don't want to do this at a 45 delta or a 36 delta heading into an earnings event. That doesn't fit my rules for trading earnings. All right, so there's a better strategy for that as far as I'm concerned for the earnings. Okay, so that's why I didn't go with that. Microsoft, what do we see there? Microsoft went and increased from 19 to 21, so 2.5%. That's a yellow light, but we'll continue on. Is it the right stock? Move it 3 ticks to the left, 13 cents wide. That fits that rule. Picking the right, what else am I missing? Picking the right duration. We want this month in about 150 days, so we're good there. And then we also have to pick the right strikes. So with Microsoft, like I said, picking the right strikes. I'm a little less aggressively bullish here because I believe that maybe we'll get a little bit of a rollover here to try and cover this gap. You had this big thing. So I'm just thinking the psychology of a trader. Like if I own Disney here at 112 and they just had earnings and you got this huge gap, who doesn't have a weak hand, right? Everybody's going to be itching to cover. And as soon as it starts to cover, then everybody else is going to pile on. But then once those weak hands get flushed out, then that's when we see that rebound. That's what I think might happen in Microsoft. Is that the correct assumption? Who knows? We'll find out. But having said that, what we want to do is I'm going to sell the 131s because that's the 36 delta. I'm a little less bullish. When I'm talking those deltas, that's the front month I was considering, the 45 delta closest You know, we could almost call that one the at the money, really. I know it's out of the money. It's 130, and this is 129.15. That's, you know, is it at the money? Yes, I'd say this is closer to at the money than that one. This one's in the money, right? So I would say this is at the money, but I'm going to go a little bit further out. So I'm picking the 131 strike here. I'm going to go, I'm aggressive. I said I was aggressive, and plus it fits with the 130. So that's how I would set it up. I'm going with the 45 delta, 30, sticking with the fact that I think it's going to roll over here. Usually don't like to get that tight, but my market assumptions got to be right. All right, so we can go and look at the break even here. We put the debit. We paid $4 in debit, so 134.43 is really where we need to get in order to be at our break even. So that's why it's also important to roll these calls out in time, continue to roll higher, and collect more premium. Get out of this debit. That debit lowers our break even, right? We talked about that. More debit we get, lower our break even is, less we have to make up to the upside. Okay? So that's a good example of a strategy we could implement right now. All right? The other one, I'm sorry, I haven't done Johnson & Johnson. I'm on Johnson & Johnson. All right, so Johnson & Johnson, we got 15 here. We've got 17 here, less than a 2% increase, $140 stock, 14 cents wide. We can see that fits the rule. Let's look at the charts and see how we came up with our bearish assumption. Again, we've got a bullish market. This market is trending higher. We just had the earnings. We don't have to worry about that one. There's going to be an earnings out here, which is good for us. Now, if we expect the market to continue to move higher at a slow pace, that's, you know, this is a low beta stock, Banu, right? Am I not right? Is this a low beta stock? So that fits our rule with that. It doesn't have to be a low beta stock, but if you're getting into this strategy as a newer trader, then I would stay away from that. All right, so 140, we're selling. We're buying the 140s in the longer duration, about 150 days out. And that's our strategy. We want this strategy to end up worthless, this call, and we ride this bad boy out. If it rolls over, won't you be worried about the short call? I'm never worried about the short call because I've got the call here, right? I've got the long call right here. So this long call, I will always have longer than this short call. So even if I roll it out, you know, ultimately this 140 is the one I got short, right? If I wanted to roll it out in time to this one, you know, I'd probably try to roll it out to the 145s if I could, right? And now I don't have on the calendar spread. Now I actually have on a real spread. It's more of a diagonal spread, right? Because I have a spread width of, you know, if I rolled this out from the 140 to the 145s that we talked about here, now I have a 140, 145 call spread on also. So if the market increases to 145, I also make up this difference in here at $5. So I've increased, I've kept the same risk really. Actually, when I've gone from a 45 delta out to a 22 delta or something like that, I've decreased my risk and increased my profitability because I've created a spread. Okay? That makes sense? Pretty simple, right? And then on this one thing we have to think about, what's the increase of 30% on our $3.14 strategy? Basically, we're going to be looking to get out at about $4. Do I have my thing on? Where's my calculator? Where did my calculator pop up? Calculator wants to hide underneath my GoToWebinar stuff. All right, so right, you know, we say a $3.14, we want it to increase by 30%. That's a hack to get 30%, just so you know, an increase of 30%. $4.08. So, when we're at $4, that's where I'm looking to get out of this strategy. So by rolling out to the 145 to a higher, we basically have the diagonal spread on. Yes, you are basically putting on a diagonal spread, long diagonal, which is fine. It doesn't have to stay the calendar, right? Especially when you're lowering your risk and increasing your profitability on it. So yeah, that's the best case scenario. I got it, John. I figured I could. Your fingers were misplaced. So that's pretty much it. It's the same strike location. The deltas we were considering, 45 and 35 days, are the ones that are closest to expiration that we're looking for. We need to make sure we have tight bid ask, so move the decimal place 3 ticks to the left. We've got that. Make sure that there is less than a 2% increase from volatility. 3 to 4, we're going to look at a yellow light, right? And then make sure our durations, we get the high theta. You can see the theta is going to be twice as much here as it is out here. 4 cents here versus 2 cents here. So we don't have that much to make up. And somebody was asking about the volatility, about the closer to expiration. You can see volatility affects the premiums less here than it does out here, right? Volatility affects further duration more than it does the near duration, is what I was trying to explain. There's a pretty good example. You don't you want to lower the debit to close the trade? Well, yes, that's kind of what I was saying with the rolling out that short call. If I roll out the short call, on this strategy right now, I paid $3.14. Well, what happens when this expires worthless and I roll it out here in time, and it might not be the 145s, and I'm probably not going to get 79 cents for that, but let's say I got 50 cents for it. Now that 50-cent collection, I get a credit there. That 50-cent collection pulls away from this. So now my break even, is when it's, all right, that's not good. $2.64 is the debit I've totally paid. So my break even would now be 142.64, not 143.14, right? This credit knocks that down to this. Have I answered your question there, Kevin? Yeah, we good? I like to make sure everybody is clear of concept before we move on, all right? So I'm going to wait for you guys. I'm not that guy to wait to the end of the webinar to go through all of this stuff, but try to pay down that premium by you sell the calls to get rid of this premium pay and lower the break even. Great. Cool. All right. So this is our deal for today, you guys. I'm not going to give you a hard pitch, but if you guys like the way that I teach, I try to teach things. I started out, one thing I forgot to mention is I started out with a psychology degree in college, all right? And then started trading with a psychology degree and switched it over to finance. But when I went to Chicago and was working on the floor of the Board of Trade, I literally told everybody that I talked to, my psychology degree is more important in trading than my finance degree. When you're trading, you're not always looking at the financials. You're looking at technicals and all of these other things, right? But technicals, to me, are the psychology of the market. That's where you see the pain people are getting in. Capitulation, that is capitulation is psychology. It has nothing to do with valuation. It has to do with fear and nothing else, and fear is psychology. So, I teach that way, protecting your portfolio, using options, and protecting your portfolio and rising interest rates, which is a really good one. So check this out. If you guys enjoyed or learned anything at all from me today, check these videos out. Check out my daily market commentaries. Some people get more out of those daily market commentaries, especially if you are a little bit more familiar with options. You can sign up for those and get that, because I talk about all my trades that I do, when and where I do them. We're doing earnings trades right now and other trades as well. But when I take them on, put them on, take them off. Han shot up through me on an earnings trade, and I'm showing how to be mechanical on a trade that is a loser during earnings, because we all have that. We all have trades that blow up in our faces. Well, how do you manage that risk? That's more important than even learning how to put on the trade sometimes. So that's what I do. So if you've enjoyed this at all, take advantage of this opportunity. For $36, you can't beat it. There's probably well over 10 hours of content there. The link I will have to throw into the chat window, and in the meantime, you can type in. I'm gonna have to find that link real quick. So in the meantime, if you're watching this on tape delay, you could just punch this into your URL. Otherwise, if you're watching this on live and bearing with me to get this out of my mouth, there it is. It is in the chat window. We've been going back and forth in the questions box. In the chat window is a direct link to that. Please check that out. Take advantage of it. I know other people can teach you how to trade options and trade this strategy, but I also don't think that people are going to break it down the way that I do, and even throw in some of those trader hacks, which I do quite often, which will, streamline your process. I mean, who doesn't want to streamline their process and get to the answer quicker? So I just want to thank you guys all. In later webinars, I'm going to be drilling down on different option components, when and where I find those trades appropriate. Here again is that link. If you're watching it on tape delay or even live, you can't use this as a hot link. It's not going to work. You'd have to pause the video or type this in really fast, because I'm not going to stay on this screen very much longer. So you can reach us at 310-598-6677 or email me at trading@protraderstrategies.com. All right. So I hope you guys enjoyed it. Again, take advantage of this. I mentioned nobody talks about this part of their portfolio, rising interest rates. And I talk about this in the daily market commentaries. If interest rates are going up, well, what does that do to the value of the bond? It's going to go down. So basically, I talk about it like, look at it like you got a teeter-totter here. And that's what happens. Interest rates go up, the price, that value of that bond goes down. Yeah, you can get back par in 30-some years, but the average person holds their bond for 7 years. And guess how long it's going to take you to try and chase yield? If you saw a bond go from 4% to 5% and you're trying to get that 5% coupon payment, how much do you think you're going to lose on the dollar value of that bond to capture that extra premium? Well, I can tell you this, it's going to take you about 6 years to make up for the difference. That 1% increase in your coupon payment will pay off the loss you felt on that bond price in about 6 years, right? There's better ways to do it. So follow this over here, because you will be much better off. All right. So I see a couple other questions pull up. I'll answer those real quick. Eric, how did you get 50-cent credit from the roll? It was 85 cents. Well, John, you're right. I took a little bit of liberty there. I was saying that by the time 20 days had gone by, and I don't remember exactly what it was. Was it this one right here? Let's just say it was. What I was saying here is, if I did this today, I've got 22 days to expiration. So this is probably going to, decay quite rapidly, hopefully, let's just say in, 15 days. 15 days from now, I decided I wanted to cover this. This, let's just say, this one's worth $1 here. Well, I'm going to get out of this one, and I'm going to go out here and sell this one. Well, I made that 84 cents on that because it went from 80. I shorted the call at $1.84. It went get out at about $1, right, when I bought it back. And if I go out here and sell another one, I was just saying that this is probably in 15 days not going to be worth 79 cents or 81 cents. It's probably going to be closer to 50 cents. That may have been confusing. I was just taking into account if I'm able to get out of this one for $1 or something like that, what's this value going to be? And it's probably going to be about 25 cents less or so. That got it? All right. Sorry, I did take that liberty in my own head. Maybe I have a tendency to do math a lot of times in my head and maybe not explain it clearly enough to everybody, which I can understand, which is also why I've gone from using, hey, you know, IV percent, you take the high and the low and divide it by the da-da-da-da-da. We got our pin now. So I'm getting a little pin happy. Let me know if I get a little too aggressive with the pin. All right. That's all I got for you guys. Take advantage of that. Or, you know, reach out to us at 310-598-6677 because we can tailor some of this stuff to you guys. Find you something that you guys really want to take advantage of. All right. So you can do that with this one. Does the interest rate change affect the premiums of the option? Yes. Row will also affect options premium as well, which, you know, I don't think the interest rates are going to go up much more than this. But when interest rates are relatively elevated, that's when we have to start worrying about that. Yeah. I don't think we're going to have to worry about row for some time. As a matter of fact, I've almost completely forgotten about row since, God, what? How long has it been since we've had to worry about row, John? I can't remember the last time I looked at it. Anyway, I think your interest rates it probably have to have been in the 90s. Blame the Fed. Yep. The Fed. Yep. I blame everything on the Fed. All right. Thanks, Ted. Appreciate the kind words. Thank you guys all. That's all I'm going to bore you with. Like I said, the link's in the chat window over there. You guys have a great time. Great weekend. If I don't see you tomorrow on Twitter. Other than that, if you can't take that, take it easy. That's right. You can't fight the Fed, Ted. It's impossible. It's a Sisyphean task. Take care, everybody.